Hey, good afternoon, everybody. This is Chris Robinson, Robinson Ag Marketing, with today's post-close grain and livestock comments for Monday, the 5th day of January. First full week of January, a nice recovery. Corn was sharply lower last week, hit 2 3 week low, 2 or 3 week lows. Finished today up at 444 and a half, four fours. I don't know if you're a numerology person, but it's better than seeing four threes, right? 444 and a half. Pretty good recovery. Uh, Managed money is you can probably make a case for them to be flat or possibly a little bit short. Although after today's action, I'd say we'll see if we can get above the 200-day moving average. I've talked about that a lot. Why does stuff like that matters? It just does. It's a big driver for the long-term trend following non-day traders out there. So we're right there, 445 and a half. If we can settle above 445 and a half, that opens up the door for another run, past 450. We've stutter stepped there quite a bit. There's a lot of resistance going all the way back to 457. If something was to happen and we'd be above 460 for whatever reason. And again, so many people forget this is a futures market. It's not a right now market. The market's telling you that maybe there's something happening here, maybe with a capital M. I'm not a big believer in these guys that are just permanently bullish, permanently bearish. I'm always uh, friendly because, let's face it, my client base is farmers, and farmers are always bullish. So I'm always looking for a reason to be bullish. But my job is to also help you protect risk and reward rallies and not get emotional. So it's a good setup. It's a good start. We'll see where we are this time next week on the 12th. We're going to get the USDA report, and then it's going to be a week of I hate the USDA, or a week of I love the USDA, or a week of conspiracy theories run amok. I would just say this: nobody knows what's going to happen. I've seen it where we get bearish reports and bullish reactions. I've seen it where we get bullish reports and bearish reactions. I just am so far done with people that um, get locked in on thinking one way or the other. We are in an uncertain business, uncertain times. There's a lot of moving parts right now, and this is the time of the year. We know that this January report's a big report, so respect it, use it, try and keep yourself in a situation where you can benefit from it, um, or at least not get completely melted down and run over if your opinions, which may or may not be bullish, maybe you're bearish, I don't know, but you don't want to let your opinions run you over, right? So, on that note, March corn up 7 cents, 444 and a half. March beans, 1062, up 16 and a quarter cent. A nice turnaround there. We almost got a 21-cent trading range. We just missed it by a couple pennies. We did finish up 16 and a quarter cent after the beans getting hammered. If you read my letter, if you're not, that's fine. That's fine too. But if you are reading my letter, this weekend I did the weekly wrap up and I pointed out the fact that the low that we saw in new crop soybeans, and at this point, guys, that's what we're looking at. What's going to happen with next year's prices? You can take the contract low, which was December of 2024, a year ago, 983. Then you can fast forward to the high in November, which nobody wanted to report, right? We hit 1131. Once we got north of $11, that was a heck of an opportunity, in my opinion. Um, but if you look at that spread, right, the $1.48, what do you think that the low was on Friday, that 1055 half area? Yeah, you'd be right if you said it was the halfway back point. And why does that matter? It's a big reset button for everybody. You know, you have to have an opinion to get involved in this market, right? From a trading standpoint. So you got to look at it this way. For a whole year, we had a $1.50 trading range. We hit that halfway back point. Now we've had a good bounce. We bounced, 25 cents here since Friday's low. That's kind of how this stuff turns around. Is there more gas in the gas tank? I don't know. The next upside target I'd be looking at is the old low where we stuttered step before, which is right around 1087, 1088. So we'll see. Is there another 13 cents to go to the upside? Hopefully there is if you are long beans. That's what you want. But I got to get back to the fact that the importance of these very simple technicals. I'm a big believer in keeping things very simple. There are so many guys out there that look at the RSI, that look at this moving average. They'll look at this stochastic, with this, that, and other thing. You can come up with 1,000 reasons to make a decision. I try and keep it very, very simple. So if you're looking for that, God bless you. Take a look at my program. If you like what you're doing, that's fine too. Stay with it. I'm here to try and help people make better decisions, bulls or bears. Moving on to the wheat. Chicago wheat up 6 cents. A nice recovery, but again, you got to remember where we were last week. You know, in the March contract, we fell to a new contract low when we hit 501 and change, 501 and a half. So a good bounce, but there's a lot more work that needs to be done there. Exports came out today. Um, you know, not surprising to see wheat exports continuing to be above the needed pace. If you're an end user and you're looking at wheat, wheat's at 5-year lows. Right? So if you're someone, imagine if you're someone that drink a lot of coffee and you know the price of coffee, which has been, God, you know, you go out to the grocery store, it's $10 for a bag, right? Suppose tomorrow if that went to $4 a bag, you don't think you're going to start stocking up on some coffee for whatever reason? So I think that's what you're seeing. That's one of the reasons the exports have been really good for wheat. And corn obviously has been the stellar explanation. You know, I'm starting to hear all kind of opinions, all kinds of ideas. You know, you got to remember this: China doesn't buy corn from us, guys. I hate to burst your bubble. They buy beans from us. Maybe they buy a little bit of corn, but they have not ever come heavily in to our corn market. We grow 15 billion bushels worth of corn every year. This year we're going to grow, you know, 16 billion. Historically, a third of that goes to ethanol. That has been the number one kind of natural put for everybody out there. As much as everybody talks about how they may like or dislike whatever programs out there are associated with ethanol, you would not be having 450 corn if it wasn't for the fact that a third of our crop went to ethanol. Should it be more? Should it, you know, obviously, yeah, I wish the whole damn crop was going to ethanol. I wish they had a reason for it because if you want higher prices, you need one thing, higher demand. So anything we can do to get higher demand is good. If you're telling me that China's suddenly going to wake up and buy 450 corn for whatever reason, great. I hope they back the truck up because the American farmer sure does need, you know, a demand story here. There's no weather story down America and down in South America. It's a little dry in Argentina. Great. We need, you know, we need something biblical down there to really turn the tables and start nailing yield. Otherwise, we're looking at another record crop of corn and beans down there. I know it's not popular to point out reality, but the reality is that's the real problem. We've got big supply coming on board, and we're going to continue to be fighting it out for market share with South America. Say whatever you want about what happened in Venezuela. I think it's a positive thing if we can decrease the influence of what are arguably our geopolitical, certainly competitors, if not outright adversaries, right? China and Russia. And I'm not even going to go into the fact of why Iran was poking around down there. But to have China and Russia sticking around in our hemisphere, it's nice to see us maybe making a move towards reasserting, you know, the dominance that we need to have in our own Western hemisphere. So maybe that'll spill over into grain demand as well. We'll have to wait and see. At the end of the day, though, that production that comes out of Brazil and Argentina and South America, it's a big production, and it's not going to go away. It's the elephant in the room for producers. It's the 900-pound gorilla in the room. It's not going away. So every year when you're deciding, hey, I got to plant corn or beans, and you look right now, does these corn at 463, does that make sense to you? Well, I can already tell you at 463, that's better than the prices that we had in 2025. You know, are we going to get $5 corn? I sure do hope so. When you're looking at November beans, you know, again, we just had a tremendous rally back north of $11 in November. Not a lot of people wanted to step in and reward that, or at least even defend $11. If we were able to get some sort of a push north of $11 here again, I think that would be a positive. What you don't want to be in a situation is where you have an opportunity to hedge or protect $11, and then 3 to 6 months from now, for whatever reason, we're sharply lower, and you're going the woulda, coulda, shoulda game. Hedging is about not having to play the woulda, coulda, shoulda game, right? And you don't have to hedge everything. Hedge 10%, hedge 20%, hedge 50%, hedge what you can hedge, afford to hedge. I understand there is a cost associated with hedging, but there's also a cost associated with borrowing money to put in a crop. You've got feed, inputs, fertilizer, anhydrous, everything. It's just, and I get it. It's just one more thing, right? But um, when you know you've got these big reports that are coming out, and the big ones are this January report, the March final acres report. We know those are big reports, and I work with some clients that we only hedge to get through those couple reports. Then there's obviously there's always the risk that we have some sort of summertime issue. Last year was the one year we didn't really get any weather issue at all, so that was very, very unusual. Is 2026 going to be a repeat of that? I don't know. um, I'm not going to sit here and tell you nice stories to make bulls like me better or bears like me better. We just don't know. That's why we hedge. So take advantage of this. Hopefully, we can get some more legs to it. We do have 5 more business days between now and the USDA report. If anybody tells you they know what the USDA report's going to do, they're lying to you. I've been through it, guys. I can tell you, I've been doing this for 30 years. There have been reports where if I had known in advance what the reports were going to be, it wouldn't have helped because sometimes the market's already baked it in, already looking past it. Remember, it's a futures market. It's not a right now market. Moving over to the hogs and cattle. Turns out during right before the end of the year, we had a couple cases show up of New World screwworm again down in South America. Excuse me, down in Mexico, not that far from our border, a couple hundred miles. And a lot of looking back, hindsight's always 2020, right? But that's probably the reason that we not only filled the gap in feeders, but have made new highs. I mean, we're at 355. There's a gap in March feeders up at 370. Are you sitting here and telling me that after we've rallied $60 off the low, you got to remember on the low, we were down at 293.30 to be sitting here at 355 and change? Anybody who tells you, oh, there's no way we're going to go back up to the and fill that gap at 370, 380, that's you're flirting with disaster. So I would continue to say what I've been saying all along. Use this rally to defend the revenue. You don't want to be in a situation where something changes and this rally gets frittered away. Most of you out there, I would say, those $60, that's worth a hedge of one way or the other. And this type of rally, where we rally $60 in a month and a half from November 25th to we call it 6 weeks, right? $60 in 6 weeks. I, if you were short futures anywhere, you're underwater right now, and you're making margin calls. If you had a put on, yeah, you paid for the put, but and you've lost value in the put, but you've not made a margin call, and you've left the upside open, all the way up on this rally. So you may have spent 5 cents on a put. We've picked up 60 cents in the cash market. If every time you paid 5 cents for a put, the market rallied 60 cents, I couldn't stop people from wanting to buy puts, right? If that was a math problem that always worked, that's why puts are generally producers' best friend when it comes to hedging. Now, if you don't want to hedge, if you don't care about it, if you're saying, hey, my father and my grandfather, none of them hedged, leave me alone, well, then that's fine too. This isn't a religious belief; it's a business decision. And let's move on to finally, real quick, to lean hogs. April lean hogs up 240 at 91 and a half, traded as high as 91.80. The last the last hog and pit report was pretty friendly. Again, that market's obviously already kind of factored that in, but I would say the same thing. We're at another 2.5 month high here today. The contract high for April hogs was 94.70. We're at 91.50 right now. It looks like this market wants to continue to go higher. So again, it's a market for using put options to defend revenue. The other flip side is, and I'll leave it on this: hedges isn't always about, puts. You want to have a hedge on until you sell your animals or your grain. But if you want to stay in the market, if you're concerned that as soon as you sell it, we're going to explode higher. I mean, if you're worried right now that you're selling a potload of hogs at 91.50 and you're worried that we're going to go back to the buck, well, when you make this sale, when you get your check, hold back a buck and a half. That's 400 to maybe $500 on a call option, and you re-own those animals on paper. If the market continues to blow up or glow up, that call option will add on to an already good sale. So hedge if you want to. If you're looking for help, give me a call, 312-638-8868. The stock market and everything, you were very, very close to get the 7,000 print. The S&P 500, I can't believe it. The Dow Jones Industrial traded above 49,000. We're going to get that 50,000 print. That seems crazy, I know. Silver. Some of you guys out there have been trading silver. We had a high print of 82 a couple weeks ago. There was a rumor that some bank failed because they were short silver, blah, blah, blah. We went from 82 to 69. We've tested that 69 level a couple times. This when we reopened this on last night, we opened up at 73. We're trading at $76 now. Are we going to go back? Is that market going to go higher? I don't know. I would just say I would expect to see $5 to $6, $7 trading ranges every day. If you're trading micro silver, that's $1,000 a penny. If you're trading the big silver, it's $5,000 a penny. If we're moving 6-7 cents a day, that's a lot of risk for most people. That's like having a 20 lot on or a 30 lot on the beans. So be careful out there. But there's some movement there in silver. We'll see if that holds on. In the crude oil market, kind of interesting, a little bit higher today. I think a lot of people thought that, what was going on in Venezuela, that suddenly, crude oil was going to collapse. I think that again, this is a futures market, not a right now market. This market has been digesting whether or not to take out 55 or go above 60. My guess is we'll trade between 55 and 60 for the next week or two. I think crude oil was more sensitive to the unemployment numbers we're going to get on Friday, because if the unemployment numbers are good or bad, that portends to demand for crude oil, right? If our economy's slowing down and everybody's getting laid off, it means that there's going to be less demand for crude oil. The silver lining to that, diesel. I've been talking about diesel, around 210, 211, 212. It traded as low as 208.90 last night, which is a 7-month low. We settled at 214. The end, it's not the end of the world if you didn't buy the low, but you got to remember a 7-month low when just 2 months ago, right? Back in the middle of November, crude oil was trading 272. People were worried about it going back up north of $3. So to be sitting down here bouncing around 210, if I'm an end user, I'm going to try and use that as well. Not to pick a low, not to take $100 and turn it into $1 million. I'm not playing that game. But if I'm an end user and I use a lot of diesel, I'm going to start taking a look at either buying your physical needs or buying some cheap calls in case we blow up. All right, on that note, this is Chris Robinson, 312-638-8868. Have a great day. Give me a call.